The Montanaro Global Select Fund invests in the highest quality, structurally growing, quoted small and mid-cap companies in developed global markets. Small and mid-cap companies, particularly in combination with a quality growth investment approach, have historically delivered investors with excellent long-term returns, which is why we like them. What's more, because smaller companies tend to be less well researched than their larger counterparts, it gives us the opportunity as active, bottom-up stock pickers to add real value. We begin by constructing what we call an approved list of around 250 companies. Given there are around 12,000 companies to choose from in developed markets, this is no mean feat, and that is why we have an extensive team of 18 analysts and fund managers to help to whittle it down. Each company we look at goes through an extensive due diligence process. As well as building a financial model and filling out a proprietary checklist for each company, we will speak to competitors, customers, ex-employees, and indeed the management team themselves, so that we can get a well-rounded view of the business and its prospects. The very best businesses can then be added to our approved list. From that approved list of 250 companies, we then select less than a fifth for inclusion in the Global Select Fund. We are long-term investors and we want to own these companies for many years. Truly great companies are rare. So while we monitor the positions in the portfolio daily, we keep turnover low because we want to let the companies compound their earnings and cash flows over time. We like to keep things simple, so there are no complex derivatives or anything like that in the fund. We simply want to own small pieces of wonderful businesses. We are active stock pickers and we purposely deviate from the benchmark. If we don't like any companies in a particular country or sector, then we simply won't invest in them. Moreover, we have a strict adherence to only investing in the highest quality, growing companies. While we believe there is excellent evidence that this approach delivers superior long-term returns, over the shorter term, lower quality, more value type businesses can outperform, and that will act as a headwind to our relative performance. We have house exclusions on ethically questionable companies making money from things like alcohol, tobacco, or gambling. More widely, we tend to think that companies which score poorly on environmental, social, or governance factors often do so because they have poor management. Given how important we think good management is to small and mid-cap companies, we try to avoid those businesses altogether. We think that most investors should have a structural allocation to small and mid-cap companies, and as markets become ever more concentrated to the mega caps, this has never been more true. But it isn't either or, and this portfolio is designed to sit nicely alongside an active large cap fund or indeed a passive product. We hope that it will help to deliver diversification benefits in that context, providing higher long-term returns with lower volatility.